Hi folks, I'm David Howes and welcome to the Australian Property Analyser tutorial. Now the purpose of using the Analyser software is to enable us to do a full pre-tax and after-tax analysis of the property before we get in the car and go look at the property. So you can gather the information you need through the real estate investor tools online, as well as through your real estate agent, to allow you to essentially analyze the property and analyze it from a capital growth, a pre-tax cash flow, a depreciation, and an after-tax cash flow point of view, in a way that allows you to compare one property to many other properties, and in a way that you can utilize information to discount properties that don't perform financially. So this is the type of report we want to produce. This is a 10-year forecast of both capital growth and cash flow, and to produce this type of report we simply have to do a couple of things with our analyzer. We go to the property financial data area and we enter some information about the property. So in this case, what we've allowed for here under purchase expenses on the bottom right hand corner of your screen there is a cash deposit on this property of $50,000. It has a registered market value of $550. It's a pair of duplex units. The property purchase amount $495,000, so we're getting it at a 10% discount. The property's valuation at purchase is $550,000. The purchase amount that we've negotiated is $495,000. So we allow for some solicitors' costs for conveyancing. Stamp duty, we simply click on the stamp duty calculator. It takes us straight into online stamp duty calculator, where at a state level, dwelling type, investment versus owner-occupied level, we can calculate stamp duty and the other related taxes, and you can see in this example $20,516. We drop that information in there, and now we come across to the mortgage information area, the mortgage calculator. We've set up a 25-year loan for the purposes of calculating P&I. In this case we're going to go interest only. I put in an interest rate right now of 6.25%. We come across to the property expenses area. We've got some rates information in there already: insurance, repairs. We've got an agent's commission of say 7.5% for managing the property. The consumer price index we set up there. In this case we're going to use 2%. That's going to govern the CPI, and for us, for this property, the rate at which insurance rates and property rental income increase on an annual basis. Now we're also going to budget on an annual capital growth rate of 6%. So that rate is an average growth rate for the next 10 years. So although we have some bumps and bruises along the way, some highs and some lows, or some periods of no growth or double-digit growth, we're looking to budget for an average of 6% compounding growth. We've got some loan costs and valuation costs set up here. We can select the income bracket of the owner of the property, just for the purpose of doing some estimation. This is not a tax calculator, but it allows us to simply estimate tax paid on income and offset that against tax credit received. In the rental income calculator area, we have a couple of options here, folks. We can either set up a holiday property, which allows us to split our rent between peak season rates, shoulder season rates, and off-season rates, and the number of weeks per year at that rate. Or if it's a residential property with the same rental income year-round, we can essentially set up the rental income. In this case, let's say for these pair of duplexes, $260 each a week, so $520 for the pair. You can set that rate up for the whole year. We can budget occupancy of 95% in this instance, so we're allowing for a 5% vacancy rate. Essentially that means 2.5 weeks of the year with tenants changing over, etc. There'll be a bit of downtime there, so we're budgeting for that too. So that's everything we need, apart from depreciation, for us to be able to have a look at these the potential income from these properties. Now with the depreciation calculator, the beauty of this is this allows you to estimate the depreciation. So this isn't a depreciation reporting tool, but it's a depreciation estimation tool, probably one of the most advanced depreciation estimation tools for investors in Australia, because if you look at this, you can select by dwelling type, including commercial and residential. In this case we'll select residential houses of less than 3 bedrooms. Nearest capital city, this one in this case is Sydney. The quality of the construction's high, so we're going to choose high. The square meterage, or the floor area of these two dwellings, is 280 square meters. The exchange date of the contract, early 2009, and the construction date of these properties, let's see, that was 2006. If you look at the bottom left-hand corner of the screen there, under the year one figure, you'll see that by these properties being constructed in 2006 and not 1977, we saw there the depreciation jumped up from sort of $1,600 or $1,700 in year one to $20,000. And I'll show you the impact on the property's financials shortly. That's everything we need now to estimate the performance of the property. I'm now going to take you through our interest only report, which summarizes the performance of this particular property. So let's start with the property purchase price up the top there, $495,000. Because we've outlaid a deposit of $50,000 on this property, Property Analyser calculates what's called an internal rate of return, or IRR, which you may have heard of. What that says is, if we take the $50,000 in cash we've outlaid to purchase this property, and we take the total returns over the 10 years in terms of capital growth, discount at purchase or equity gained at purchase, cash flow after tax along the way as well, this particular investment gives us an average 94% return on an annual basis on our $50,000 investment, or almost 100% of our deposit back each year by way of cash flow or capital growth. So let's see how that sort of plays out. We can see when we go to the property market value line there, that 6% compounding growth that we talked about. We can see $550,000 is the valuation today. By the time we get to the end of year 10, we're looking at a property with a value of $984,000 if it grows at just 6%. And what we see there, of course, is on an interest-only loan, the loan balance staying constant and our equity in the property growing from $80,000 initially. By the time we take the discount into account, by the time we put the deposit into the property, and by the time we offset some costs like stamp duty, we start off with that equity and then growing to over $500,000 by year 10. The loan to value ratio percentage allows us to see how highly we are geared. So we can see that although we start off with a loan to value ratio, or LVR, of 85%, that by the time we get to year 10, our gearing's dropped to below 50%, and the surplus equity for reinvestment calculator allows us to see, if we're setting a loan to value ratio target up here at the top left corner of 80%, that by year 4, because our loan to value ratio has now dropped 67% of the property's value because of the capital growth, we can now top up our mortgage or refinance, pull out that $88,000, use that as a deposit to then borrow another $441,000, and essentially, go buy another property of, say, $520,000, $530,000 worth of value. So this allows us to look at equity and the point at which we can redraw based on capital growth and stuff like that. So that's helpful for wanting to know when we can get the equity back out of the property. When it comes to average weekly rent, by the time we take vacancy rates into account, we can see year 1 income $25,688, and as we said, growing at 2% with inflation each year, hence why the rent's creeping up over the 10-year period, giving us a gross yield right now of 5.2%, or essentially, our rental income as a percentage of the purchase price of the property. Now, once we take off the property expenses, our net yield of 4.4% is essentially the surplus we have to apply to the mortgage interest payments. We've got a negative cash flow position of minus $7,643 a year that we would be using to support or prop up this property. Now, because we can apply depreciation of $20,400 in year 1, we can create, along with the property expenses and the mortgage interest payments, total taxable deductions of just under $55,000 a year. So what that means is, from a tax point of view, because our income on this property is $25,000, then we've created a net loss situation. That's what the bracket signifies, a net loss situation of just under $29,000 a year. And against the tax we've paid in our top income bracket, we can claim a tax refund or a tax credit. In this example, as a salary earner or a wage earner, or paying tax of just over $11,000 a year, meaning that by the time we offset that tax refund against our negative cash flow up here of $7,500, our net result after tax is a phrase commonly known as a positive cash flow property after tax, or in this case, we're in the black by $3,874 a year, or $75 a week. Thanks for watching this tutorial. We hope you get a lot more out of using Property Analyser software now that you've seen this. If you're not already a member of Real Estate Investor, feel free to come to one of our webinars and check out our tools and how to make best use of them to find, analyse and track real estate across the New Zealand and Australian real estate market.